In a world where change is the only constant, Mo Shamil stands at the forefront, guiding title professionals to not just grow their businesses, but to master the art of innovation. With every episode, you're handed the keys to unlock unparalleled growth and stay ahead of the curve. Get ready for a transformative journey.
Welcome back to The Deep Dive. It is February 2026. And I have to ask, do you feel that?
Feel what?
The calm. It's just quiet out there. I mean, if you rewind the clock just 12 months to the start of 2025, the financial world was basically hyperventilating.
Well, it was incredibly tense. You could cut the anxiety with a knife.
Exactly. But we wake up today, the sun is shining, markets are chugging along, and that whole end of the world vibe is just gone. It's like the storm just missed us. So today we're figuring out why.
And we're digging into this massive legislation that seems to have fixed the plumbing of the economy, the Omnibus Budget Reconciliation Bill.
The OBBB, or as some people are calling it, the Big Beautiful Bill.
This is a terrible name.
A truly terrible name. Sounds like a cartoon character. But you're right about the shift. To understand why it's calm now, you have to remember what we were all staring down a year ago. The sources all call it the tax cliff.
Tax cliff, yeah.
Right. And this was all about the Trump tax cuts expiring, correct?
That's the shorthand, yeah. Technically, it was the 2017 Tax Cuts and Jobs Act. It had this self-destruct mechanism built right in, set for the end of 2025.
So if Congress did nothing?
If they did nothing, on January 1st of this year, just a few weeks ago, income tax brackets would have jumped, standard deductions would have been slashed, estate tax exemptions cut in half.
So it was a massive automatic tax hike for pretty much every single American overnight.
Precisely. And that created, the best word for it is paralysis.
Yeah.
Investors were just sitting on their hands.
Nobody wanted to make a move.
Nobody. You didn't know what the rules of the game were going to be in 6 months.
Yeah.
And uncertainty is the absolute enemy of money.
It really is. But then, smack in the middle of summer, July 4th, 2025, which is fitting, the OBBB gets signed.
And the big headline isn't just that taxes stayed low, it's that they became permanent.
And that seems to be the core theme of everything we've read for this deep dive. It's not just saving a few bucks on your tax return, it's about certainty.
That is the one-word takeaway. The transaction engine of the economy had stalled because of fear. This bill, it didn't just top up the tank, it poured jet fuel in it.
Okay, so the engine's running. Let's pop the hood. We've got a lot to cover. Salt caps, depreciation, something about a rural gold mine. But let's start with the one that hits home for a lot of people. The salt cap.
The state and local tax deduction.
This one made people in New York and California absolutely miserable.
Miserable is a good word for it. Yeah. Think about it. You're living in a suburb of New Jersey. You're paying, say, $35,000 a year in property taxes. Under the old rules, you can only deduct 10 grand of that.
So that other $25,000 you paid, just gone.
It's just gone. Phantom money. You got zero federal credit for it. It felt like double taxation.
So what did the OBBB actually do here? Did they just get rid of the cap entirely?
Not fully. That was the hope for a lot of people. But the compromise was a big expansion. The cap was raised from $10,000 up to $40,000.
Okay, a 4x increase. That's significant. But is $40,000 enough to actually cover most people in those areas?
For the vast majority, yes. It covers the property tax bill for most upper middle class homes. Now, there's a catch. The sources are very clear on this.
There's always a catch.
It only applies if your modified adjusted gross income is under $500,000.
Got it. Okay, so this isn't for the mega rich, but for a family making, say, $300,000 or $400,000, this is real money.
It's huge. But here's the deeper thing, the real market impact. It's not just about your tax bill in April. It's about liquidity in the housing market. We're calling it the SALT surge.
Unpack that for me. How does a tax deduction make people move house?
Well, think of it like golden handcuffs. For years, people in these states were capped out. If they moved to a bigger house, their property tax bill would skyrocket, and they couldn't deduct any of that increase. So they just stayed put.
They were frozen.
Exactly. This unfreezes them. It gives a move-up buyer a reason to move. That larger home in Westchester you were eyeing. The math just changed. The government essentially handed you a coupon for an extra $30,000 deduction.
That's a fascinating way to look at it. It's not just a tax break. It's a lubricant for the market.
And volume is everything in real estate. It drives commissions, renovations, the whole local economy.
Okay, so homeowners are happy. They can move. But looking through these sources, The real excitement seems to be coming from professional investors, specifically about something called bonus depreciation.
Oh, the investors are throwing a party, an absolute party.
I have to admit, I thought bonus depreciation was dead. I remember it was phasing out.
It was on life support. It was scheduled to drop to 40% in 2025 and then head to zero. The OBBB just slammed the car in reverse. It restored 100% bonus depreciation and made it permanent for assets acquired after January 19, 2025.
Permanent is a strong word in tax law, but hold on. Bonus depreciation. It sounds like corporate jargon. Break this down. Why is this such a cheat code?
Sure. Let's say you buy an apartment complex for $1 million. Normally, the IRS says, okay, that building will last 27 and a half years, so you can write off a tiny slice every year.
Which is boring and doesn't help with cash flow today.
Right. It's a slow drip. To use bonus depreciation, though, you have to pair it with something called a cost segregation study.
Cost seg. I hear my real estate friends throw this around all the time. It always sounds like they're getting away with something.
It's not magic, just engineering. You hire a firm, they walk through your new building, and they say, look, you didn't just buy a building, you bought carpet, you bought light fixtures, you bought fancy blinds, you bought landscaping.
They break the building into its component pieces.
They segregate the costs. And here's the kicker. Carpet doesn't last 27 years, maybe it lasts 5. So the IRS lets you write off the entire value of those items in year 1.
A whole thing in the first year.
100% of it.
So back to that $1 million building. What are we talking about realistically in terms of a deduction?
You can often find 20 to 30% of the building's value in those short life assets. So on that $1 million purchase, you do the study and you generate a $300,000 tax deduction immediately.
Wow. So if I have $300,000 in other income, this paper loss could wipe that out.
Potentially, yes. It depends on your professional status with the IRS. But for many people, it creates a massive tax shield. It frees up capital that would have gone to Uncle Sam. So you can go buy the next building.
That's the velocity the sources keep talking about. It keeps the money moving.
Exactly.
Okay, so alongside that, there's another acronym, QBI, Qualified Business Income. This is the 20% deduction on rental income.
Right. It's basically a 20% haircut on your taxes. You profit $100,000 from your rentals. The government says, great, you only pay taxes on $80,000. And the OBBB made this permanent too.
It just sounds like free money.
Well,
I hear a but in your voice. There's always a catch, isn't there?
there is a trap here, and a lot of amateur investors fall right into it. The sources call out the 250-hour rule.
250 hours.
To get that 20% haircut, the IRS requires that 250 hours of rental services are performed on the property each year.
I mean, 5 hours a week? That doesn't sound impossible.
It's not, but you have to prove it. You have to log it. And here's the distinction that catches people. It has to be active. If you own a triple net lease property like a Walgreens, where the tenant does everything.
The mailbox money lifestyle.
Exactly. If you just collect a check,
Yeah.
that does not count. You're excluded from the QBI deduction.
Oh, that is a huge distinction. So if you're just passively clipping coupons, no 20% discount for you.
Correct. The government wants to reward active business owners, not just passive investors. It turns investing into a more consultative, hands-on process if you want that tax break.
Speaking of doing the work, let's talk about Section 179. This is for equipment, right? Like buying a tractor.
Usually. But the OBBB expanded it to include what they're calling heavy systems for commercial buildings.
Heavy systems. Sounds intense.
It's the unsexy stuff. Roofs, HVAC, fire protection.
The nightmares. The things every building owner dreads paying for.
Exactly. Imagine your warehouse roof collapses. That's a $500,000 bill. Under the old rules, you'd have to depreciate that new roof over 39 years.
Ouch. So you're out the cash, but you get almost no tax benefit to offset it.
Right. It's a massive drag on cash flow.
Eh.
But now, Section 179 limits have doubled to $2.5 million. And you can write off that entire roof for the year you buy it.
So you spend the cash, get the full deduction, and it replenishes your reserves.
It's a flywheel. It encourages landlords to actually fix their buildings, take the write-off, and use the savings to buy more property. It just speeds up the whole investment cycle.
I want to pivot to something that feels a bit more geographic. Opportunity zones, OZs.
Yes.
This was the hot topic a few years back, but I thought the program was basically dying. Wasn't there a hard deadline in 2026?
There was. December 31st, 2026. Everyone thought the program was about to become a zombie.
So what happened? They just extended it.
They did something better. They introduced Opportunity Zones 2.0. And the headline change is what they call the rolling clock.
Rolling clock.
Instead of a hard deadline, the new rule is simple. As long as you hold the investment for 5 years, you get the benefits. It doesn't matter when you start, the program is effectively alive indefinitely.
That's huge. It takes all the pressure off. You don't have to rush into a bad deal just to beat the calendar.
It does. But the really interesting part of OZ 2.0 is where they want you to put the money. They've added what's being called a rural gold mine incentive.
I saw this. Towns with under 50,000 people. Why rural?
Think about yield. Major cities, LA, Miami, they're saturated. Yields are compressed. There's too much money chasing too few deals. But these rural zones, they're starving for capital. The government is essentially paying you a premium to go where the big institutions won't.
So I shouldn't be looking at a condo tower in Austin. I should be looking at a small manufacturing plant in Ohio.
Or a multifamily complex in a developing part of Texas. That's where the alpha is now. You get better cap rates and better tax treatment.
Okay, but there's a warning here in the notes about a dead zone. That sounds ominous.
It is a timing trap, and getting this wrong could cost you millions.
Walk me through it. Give me a scenario.
Okay, so we're in this transition period between the old OZ rules and the new 2.0 rules. If you have capital gains, say you sell a business, and you invest that money before December 31st, 2026, you're stuck under the old expiring rules.
Okay.
But if you invest that money after January 1st, 2027, you get the new 5-year rolling clock and all the permanent benefits.
But my scenario, it's November 2026. I sell my business for $5 million. I have a huge gain. What do I do?
You have to be so careful. If you rush to put that money into a fund in December to get it done, you might lock yourself into the inferior rules.
So I just hold the cash and pay the tax?
No, you get creative. You use an installment sale.
Yeah.
You sign the deal in November, but you structure it so the final payment, the part that triggers the tax event, doesn't hit your bank account until January 2nd, 2027.
You bridge the gap.
You bridge the gap. You push the gain into the new year to unlock the better permanent benefits. It's a pro tip a lot of general CPAs might miss.
Fascinating. So what about the people who are done acquiring, the people who just want to keep what they've built? The legacy crowd.
State taxes. Yeah. This was a huge fear. People thought the exemption was going to drop to something like $3 million.
Which would force families to sell everything just to pay the tax man.
That was the fear. But the OBBB held the line. The exemptions are safe at roughly $15 million for individuals, $30 million for a married couple.
That's a relief for a lot of people.
But the bigger win, the one that really matters, is this step up in basis.
Remind us what that is again?
Okay. Say you bought a building 30 years ago for $100,000. Today, it's worth $5 million. If you sell it, you owe capital gains tax on that $4.9 million of profit.
Which is a huge check to write.
A huge check. But with the step up in basis, if you pass away and leave that property to your kids, the value is stepped up to the current market value, to $5 million.
So the IRS pretends my kids bought it for $5 million.
Exactly. So if they sell it the next day for $5 million, that $4.9 million taxable gain, it just vanishes. Gone.
So if the step up is safe and the exemptions are safe, that completely changes the game for older investors, doesn't it?
It completely changes the psychology. For the last year, I saw panic selling, people trying to beat the tax hike. But now they have peace of mind to hold.
They don't have to sell.
They don't.
No.
And actually, I want to leave the listeners with a thought that's a little counterintuitive. We're all taught that the goal of real estate is buy low, sell high.
Sure. Business 101. You make your money when you sell.
But with these rules locked in, the smartest move for an older investor might be to never sell, ever.
Never sell. How do you live? You can't buy groceries with a brick wall?
You refinance. Debt is not taxable income. You have a $5 million building. You refinance, pull out $2 million in tax-free cash to live on. You keep the building. Then eventually you pass away.
And the property goes to the heirs with a stepped-up basis.
Exactly. The tax liability is wiped out. They sell the building, pay off the loan you took out, and they keep the rest.
Buy, refi, and die.
It sounds a bit dark when you say it like that.
It's incredibly dark, but financially,
it's brilliant. And under the OBBB, it's a strategy that's now safe for the next decade.
That is definitely something to chew on. So zooming out, the OBBB, it is not just a boring budget bill.
No, it's a permission slip. The government has signaled, we want you to move money into roofs, into rural towns, into new construction. And if you follow those signals, the tax code pays you back.
Certainty.
Velocity. And maybe, just maybe, never selling a thing.
That's the summary.
Listeners, pull up your portfolio. Are you missing a Section 179 deduction? Are you ignoring a rural town that just became a gold mine? The rules are set. It's time to play. Thanks for joining us on this deep dive.
See you next time.
In a world where change is the only constant, Mohs Shamil stands at the forefront, guiding title professionals to not just grow their businesses, but to master the art of innovation. With every episode, you're handed the keys to unlock unparalleled growth and stay ahead of the curve. Get ready for a transformative journey